Namaste, welcome to Arthneeti, where we discuss money and money related tools to help you in your everyday investing decisions. I am Dr. Shefalika Gokhale. I hold a PhD in business practices of mutual fund houses. These videos are a part of the customer awareness initiative of Samyak FinServe. Now, in this video, we will discuss banking sector. It says numbers don't lie, and the results of the banking sector, which were announced for the first three quarters of the current fiscal, stood at nearly 3.1 lakh crore rupees. These included private sector as well as public sector banks. In this video, we will discuss whether the banking sector is fit to be part of your portfolio. We will discuss the numbers that were declared, also the government and RBI revival strategy for a turnaround that has happened in the public sector banks. We will discuss that. We will discuss the position of public versus private sector banks, and final takeaway of what points, what knowledge you should ponder upon while taking a decision whether this sector is suitable to be part of your investment portfolio. So let's start. The numbers declared by the banking sector are superlatively good enough to instill optimism in the minds of investors. For the financial year 2024, banking sector recorded a whooping 3.1 lakh crore rupees of profit. Now, this is a significant jump of nearly 40% than the profits they declared in financial year 2023, which stood at 2.2 lakh crores. Now, the composition of this 3.1 lakh crores is as follows. Public sector banks recorded 1.4 lakh crore rupees profit, and the remaining 1.7 lakh crore rupees profit was recorded by the private sector bank. This is a good 42% jump from the previously recorded profits of private sector banks. Just to give you a perspective of how big this number is, Indian IT sector, which has been a strong point in our economy, the total of the profits of all listed IT companies in India for 2024 financial year stood at 1.1 lakh crore rupees. Now compare this with the 3.1 lakh crore that the banking sector has delivered. There is a huge gap. Obviously, banking sector is in a way bigger league than IT when it comes to investment opportunities for investors. The picture of the banking sector now might be very attractive, but this was not so too long ago. It is very important that we do not forget history, because if one forgets what happened in the past, there is a risk that the same mistakes might get repeated. So, a little brush up about where the banking sector was in the near past and what achieved this turnaround in this sector. Take 10 years back. In 2013, the public sector banks were in a dire state. They were riddled with home loans thanks to misrepresentation in accounting. The system was on the verge of collapse, and the economy would have gone downhill if corrective action were not taken. But a cleanup effort was undertaken. Bad loans were exposed. It wasn't smooth sailing. Public sector banks even reported a huge loss of 85,000 crore rupees in the financial year 2017-18. Fast forward today, they have recorded a profit of 1.4 lakh crores. Now, how was this possible? This was not possible without effective steps which were undertaken by the government of India, the RBI, and the banks themselves. Now, recapitalization of public sector banks was undertaken. The government injected 3.1 lakh crore capital, fresh capital in the public sector banks during the financial year 2017 till 2021. This strengthened the capital base and improved the lending capacity of public sector banks. A 4R strategy for NPA management was introduced. The 4Rs were recognition, resolution, recapitalization, and reforms. Now, as per this strategy, a bad bank was established, National Asset Reconstruction Company, which you can also call as a bad bank. This was established in 2021. The main objective of NARC was to acquire bad loans from public sector banks so that capital of these banks is freed and they can operate more efficiently. After that, the loans that were acquired were resold to specialized investors who specialized in turnaround of stressed assets. This would be done with the help of another entity which Government of India formed, India Debt Reconstruction Company Limited. So NARC basically is a bank which takes up bad loans or stressed assets from the banks, resells them, and clears up the capital of the banks. Now, this is not the first time that this is happening in India. Other countries like Malaysia, Ireland, Korea have implemented a similar system to clean up their financial systems. NARC has acquired stressed assets or bad loans to the tune of nearly 92,500 crores till the end of March 2024. 6 months later, till September 2024, they aim to acquire stressed assets to the tune of 2 trillion, 2 trillion crore rupees. And they are on track to achieve that target. The government of India also resorted to mergers and acquisitions. It consolidated the public sector banking landscape through strategic mergers to create stronger entities with better risk management capacities. Some examples: in 2019, Bank of Baroda was merged with Vijaya Bank and Dena Bank. In 2020, OBC and United Bank of India were merged with Punjab National Bank. RBI introduced stringent regulatory measures, prudential norms like stricter capital adequacy ratios to ensure banks have sufficient capital and buffer to withstand any financial shocks. Secondly, they focused on asset quality, strengthened supervision, and risk management frameworks to promote responsible lending by banks. And thirdly, technological advancement, adoption of digital technologies to improve efficiency, transparency, and risk management of the banking system. Now, these were the strategies which government as well as RBI implemented so that a significant turnaround could be possible in the banking sector. Now, when you have to decide between public sector and private sector banks, things become more interesting. Let us dive deep. Let us first look at public sector banks. Now, for years, public sector banks have been struggling with NPAs. But thanks to the revival strategy implemented by the government and the RBI, we discussed that strategy earlier. It gave a new lease of life to the public sector banks. Their balance sheets have been cleaned and their financials are looking healthy. So much so that SBI, the biggest lender in the country, recorded an enormous profit of nearly 20,000 crore rupees for the fourth quarter of the last financial year. Now, Reliance, which has traditionally been the highest grosser in terms of profitability, recorded a profit of nearly 18,900 crores. So SBI even surpassed Reliance in terms of profitability. When you look at SBI profit 10 years back, the profit that SBI declared in May 2014 stood at 3,041 crore rupees. 10 years later, in May 2024, the profit stands at 20,698 crore rupees. This is a good enough signal of the health of the economy as well as the resurgence of public sector banks. But though the financials look good, when you compare private and public sector banks, public sector still faces challenges in terms of operational efficiency when compared to their private sector counterparts. Now, let us look at private sector banks. Well, private sector banks have been consistent performers. They maintain a healthy profit margin and have lower NPA ratios. They are generally considered less risky investment. Why? Because of their strong financial health. But growth prospects of private sector banks are slightly lower as compared to the resurgent public sector banks. So there are pros and cons when it comes to private sector and public sector, but focus on the health of the financial book, the lending book of the banks, how deep it is and how healthy it is. Also focus on the banks which are implementing technological advancements to better customer experience. Focus on these 2 points when you have to decide between public and private sector banks. So, what points should you consider if you wish to invest in the banking sector today? Well, the banking story has many positives, but you should be aware of potential roadblocks in this sector as well. Jeffries, which is a brokerage firm, says that private sector bank is a straightforward story and recommends them for investing. But ICRA, the rating agency, anticipates credit growth and profitability to slow down in the year 2025. Also, before taking any decision of investing, it is very necessary to ponder on these points. What will be the government regulations going forward? Well, the government till date has infused capital into the private sector banks. But what regulations in the future and policy changes that the government implements will impact the profitability of the market? So, after the elections, what are the policies that the government undertakes is something that you should check before taking any decision of investing. Fintech, which is a rising sector in the Indian economy, presents both challenges and opportunities. Banks that embrace digital transformation and implements technological advancements in its system can efficiently cater to the challenges that fintech pose, better the customer experience, and gain competitive advantage. Secondly, one should not look at Indian banking in a vacuum because they are susceptible to global economic headwinds. If the global economy slows down, interest rates keep on rising, this would impact the growth and profitability of the banks. So, what is happening around the world will definitely have positive or negative impact on the banking sector. Secondly, banks are the profitability of the banks is very sensitive with the interest rates. High interest rates have boosted the net interest income of the banks and enhanced their profitability. When RBI lowers interest rate, it will encourage more businesses and consumers to take up loans. Why? Because the loan rates as well as the FD rates will come down once the RBI starts reducing the interest rates. But even though the loan book will flourish, profit from each loan that the bank gets will be lower, right? So these points should not be uh, left behind or should not be ignored when you are investing in this sector. The NPA situation might have improved significantly, but credit quality and NPA management are still points which should not be looked away from before you take any decisions. Lastly, I want to tell you about what Prashant Jain, the celebrated fund manager from HDFC, who now has quit HDFC Mutual Fund and started his own PMC. What he says is Indian banking sector does look very attractive. He gives good value to the banking and power sector in the future. Banks, he says, have suffered from bad loans, but IBC and reforms undertaken by the government and the RBI has cleaned up the NPAs in the last 5 7 years. He says banks which have a deep liability book, which is healthy and which is tech centered, which focuses on technology to service its customers, has good future. So he does not name any banks, but he says you can very well read about this, which banks have a loan book which is healthy and deep, and which banks prioritize the use of technology in its banking system. So focus on those kinds of banks for your investment. Secondly, I'm sorry, lastly, what I want to say is when you invest in a banking sector, don't expect uh, windfall gains, because this sector has the ability to give you average returns over a period of time. So if you are looking for something which is going to give you good returns over a longer period of time and not sudden windfall gains, this is the sector for you to invest in. I hope this video of mine has added value to your investing journey. If you have any questions, please feel free to ask in the comments section. Also, please like, subscribe, and share my channel and help it grow. Thank you so much. Until next time, stay safe. Goodbye.